All right, let's dive right in. Today we're going to break down the key metrics, the KPIs that the best marketing leaders use to drive serious, sustainable growth. But first, we have to talk about a fundamental truth of marketing today.
Yeah, if you're a marketer, this probably hits close to home, right? You are absolutely swimming in a sea of metrics, clicks, impressions, likes, shares, you name it. There's so much data coming at you, it's incredibly easy to lose sight of what actually grows the business.
So that really is the million-dollar question. How do the best CMOs stay laser-focused? Well, here's the secret. They don't track everything. They use a kind of strategic compass, just a handful of really powerful KPIs to guide every single decision. And today, we're going to walk through that compass, piece by piece, starting with the bedrock.
Okay, first things first. We have to talk about the absolute foundation of any growth model, making sure you can actually afford to grow. This is all about the basic economics of getting a new customer in the door.
Our first KPI is Customer Acquisition Cost, or you'll hear it called CAC. It's super simple. You just take all your marketing and sales costs over a certain period and divide that by the number of new customers you brought in. It's basically answering the question, what does it cost us to get one person to buy?
Okay, so you know the number. Big deal, right? Well, yeah, it is a huge deal, because knowing the cost is one thing, but understanding what it really means for your business, that's what separates the pros from the amateurs. CAC isn't just an expense, it's a vital sign for your company. Think of it this way. Your CAC tells you if your growth engine is an efficient hybrid or a gas-guzzling monster. If you have a low CAC, that means you've got the fuel to scale up fast. But a high CAC? Whoa, that's a major red flag, warning you that if you step on the gas, you could drive the business right off a cliff. But look, knowing what a customer costs you is pretty useless unless you know what they're worth to you. And that brings us to the other side of the equation, customer lifetime value, or CLTV. This metric predicts how much total revenue you'll make from the average customer over their entire time with you. It answers the question, okay, once we pay to get them, what's the long-term payoff? Now this is where the magic happens. When you put these two metrics, CAC and CLTV, together, you get what might just be the single most important ratio in all of growth marketing. It's the number that tells you if your business model is a winner or if it's fundamentally broken. And here it is, 3-to-1. The gold standard that most VCs and top companies look for is earning $3 in lifetime value for every $1 you spend to get that customer. This is the sweet spot. This is the benchmark for healthy, scalable growth.
This ratio is like a diagnostic tool. It tells you exactly where you stand. So anything below 1-to-1 is obviously a disaster zone. You're literally paying to lose money. But here's the part that trips a lot of people up. A ratio above 5-to-1 is also a red flag. It means you're not investing enough. You've found a winning formula, but you're not funding it properly and you're leaving a ton of growth on the table for your competitors to grab.
Okay, so you've dialed in your core economics. You know you can grow profitably. The next big question is how do you feed that engine? And that brings us to our second pillar, the metrics that show how good you are at turning someone's casual interest into real action. This whole process really starts with the Marketing Qualified Lead, or MQL. Now, an MQL isn't just any name on a list. No way. This is a prospect who's raised their hand and shown real buying intent, by filling out a form or watching a demo. Tracking your MQLs lets a CMO actually forecast the sales pipeline and make sure marketing is giving sales high-quality leads that are ready to go.
Now, for paid ads, the metric you live and die by is return on ad spend, or ROAS. It asks a dead simple question. For every single dollar we put into a platform like Google or Meta, how many dollars of revenue come back out? This is your channel-by-channel health check. It ensures your ads are actually helping your CAC, not just burning through cash.
But really, underpinning all of this is your conversion rate. Having 1 million visitors to your site is just a vanity metric if none of them actually do anything. Conversion rate measures the percentage of those people who take the action you want them to take, whether that's signing up, buying something, or booking a call. This is where traffic turns into real business value. So how do you make that number go up? Well, the best CMOs have a playbook. They run a constant loop of optimization. They're A/B testing different offers and calls to action. They're tweaking the messaging on the page to make it clear. and they're making sure that the ad a person clicks on perfectly matches the landing page they see. Even a tiny lift here, like 0.5%, can have a massive downstream impact, making your whole acquisition engine cheaper.
Let's be real. Acquiring customers is expensive. The real profit, the secret to that healthy CLTV we keep talking about, is in keeping the customers you've already paid to get. And that brings us to our third pillar.
And here, we've got to look at two related but very different metrics. First is activation. This is all about that crucial first experience. Did your new user find that aha moment where they really got the value of your product? But one aha isn't enough. That's where retention comes in. It measures if they keep coming back for more, week after week. You have to have both.
Man, this quote just says it all, doesn't it? If your product is a leaky bucket, then every single dollar you pour into acquiring customers is eventually just going to leak out. It's wasted. But a product that keeps its users, that creates this incredible virtuous cycle where growth actually gets cheaper over time.
Okay, so we've looked at metrics for getting customers, for converting them, and for keeping them. But how does a CMO roll all of this up into a single, powerful number for the CEO and the board? That brings us to our final keystone metric, the big one.
So a lot of people get ROAS and marketing ROI confused, but the difference is critical. Think of it like this. ROAS is tactical. It tells you how your Facebook campaign is doing. But marketing ROI is strategic. It looks at the return on your entire marketing investment. That includes the ad spend, the software you use, and yes, even the salaries of your team.
And that is why marketing ROI is the ultimate scorecard. This is the number that justifies your team, your budget, your entire function. It proves, in the language the rest of the business understands, that marketing isn't a cost center. It's a primary engine for growth.
Okay, let's pull this all together. Think of this grid as the CMO's strategic playbook. You can see exactly how they think. They don't just track random numbers. They start with a business goal, like efficient acquisition. Then they pick the right KPIs to measure it. Our friends CAC, ROAS, and MQLs. And finally, their job is to take action, like shifting budget to the channels that work best. It's a complete system, connecting every single metric to a real business outcome. Because at the end of the day, all of these numbers, all these dashboards, they're just tools. They're useless sitting on a screen. The real value, the thing that actually moves the business forward, is making smart decisions based on what that data is telling you.
So I'll leave you with this one question to take back to your team. Take a really hard look at your dashboards. Are you tracking the strategic KPIs that actually drive profitable growth? Or are you getting lost in the noise, tracking the vanity metrics that are easy to see but don't really matter? Getting that answer right, well, that could change everything for you. Thanks for joining.